Throughout the history of the stock market, finding undervalued stock has been one of the best ways to outperform the market over the long term. This approach involves purchasing stock and selling the companies that are lower priced as compared to their major competitors. So, how do you find an undervalued stock? What's up guys? Welcome back to Glory Investing Show. In our today's video, I'm going to tell you how you can find undervalued stocks. But before we go any further, make sure you smash that subscribe button and don't forget to hit that bell icon so you never miss any updates. Now without further ado, let's get into this. Okay, so first of all, you need to go on YouTube and type... I'm just kidding guys. You need to understand how we can evaluate a stock. For this purpose, you need to understand the traits of the companies you're looking at. For example, how much money the company is earning. What is the growth rate of this company? How much money you can expect to make in the future if you invest in this company. And moreover, you also need to consider liquidity and solvency. What is the risk of the company going bankrupt? And how quickly it can turn assets into cash. These traits can help you evaluate a stock. You also need to learn the history and story of that company. Firstly, I will tell you about the tools you can use to find undervalued stocks. After that, we will discuss some indicators of undervalued stocks. So nowadays, there are several free online tools that can help you search and screen investment ideas within a few seconds. You can start with a stock screener like Ally Invest. Now, if you choose to use Ally Invest, you will have access to two types of screeners. First, there is a screener with around 80 criteria to choose from, along with 6 predefined screeners. Secondly, there is a technical screener powered by Cognia. Other stock screeners are Yahoo Stock Screener and Google Stock Screener. Now, if you want more in-depth search capabilities, you can always go with paid options such as YChart Stock Screener. With that being said, let's talk about the 6 criteria investors usually look for while identifying an undervalued stock, and after that, we will see why are stocks undervalued. First, you need to determine whether the price-to-earnings ratio of a stock is low or high. If the P ratio is higher, it means that the price of the stock is higher relative to its earnings. On the other hand, a relatively low P ratio indicates that the price of the stock is lower relative to the earnings. This means it is a buying opportunity. It is worth mentioning that there is likely a reason for the low P ratio. Now, if the share price of a company is lower as compared to its competitors, it means that there might be an underperformance situation. Now, this lower share price could happen for a number of reasons. We all know that it isn't unusual for a single voice in the Wall Street Journal to cause a whiplash effect as investors sell off to drive the price of a stock down, right? After you have determined the lagging relative price performance and price-to-earnings ratio of a company, you need to move on to a more accurate factor, which is the price-to-earnings growth ratio of a company. To calculate the price-to-earnings growth ratio, simply divide the price-to-earnings ratio by the earnings growth rate. If the result value is less than 1, investors might be giving more weight to past performance than to future growth opportunities. That is pretty much telling that this is not the right time to invest money in this stock.
Excuse me. Yeah. Is that your car on the lot?
What if the company is paying more dividends to its investors as compared to its competitors? Well, this indicates that the share price has dipped to undervalued status. I would say that if the company is not going through financial troubles and future dividend payments appear secure, the dividend opportunity can provide returns in the short term and the potential for the stock price to grow in the future. Prime example of healthy dividend strategy is, for example, Apple, and terrible example is AT&T.
Berkshire Hathaway common stock.
The fifth indicator of an undervalued stock is a low market-to-book ratio. This means that if a company has a low market value as a ratio to book value, it is undervalued. For those who don't know, market value is the total market cap of the company, while the book value is the total shareholder equity. The key to finding an undervalued stock is understanding the real value of tangible assets such as cash, building, and land, as well as intangible assets such as intellectual property and goodwill. For instance, suppose that a company is engaged in the business of producing and selling toys and also owns the property. The value of the property could potentially be worth more than the toy business it operates. Some investors may overlook this factor, and the stock price of that company won't reflect the underlying value of assets the company has on the books. Lastly, you need to consider the free cash flow of that company. I've seen that many investors put less emphasis on reported profit and more on free cash flow. For those who don't know, the free cash flow of a company is basically the amount of cash generated by the business after all expenses are accounted for. Now, a stock might be low priced because lower reported earnings may be a great deal in terms of cash flow. You also need to understand the reasons why some stocks are undervalued. Where there are a ton of reasons why it could become undervalued, however, 3 reasons generally fall in one of these 3 categories. Of course, one of the major reasons why a stock could become undervalued is that it might have missed quarterly earning expectations. If bad news or bad quarterly reports are published about the company, the price of shares could plummet far more than they should. Moreover, if the company has a massive recall on its products or suffers other forms of unfortunate press clippings, the price of these shares could drop considerably in a short time. I would highly suggest that you do your own research to understand how serious the bad news is first. Many people don't understand that some sectors can be more volatile as compared to others, or they could at least be more cyclical than others. For instance, if a business supplies discretionary spending opportunities for consumers, it will perform better when the economy is strong. I would say that you focus on sectors that are out of favor for good bargains if you want to find undervalued stocks. And finally, the last reason why a stock could become undervalued is that it might have experienced a market crash or correction. I believe that one of the best times to look for undervalued stocks is during a market pullback. In the end, let me tell you that undervalued stocks have lower market value as compared to their intrinsic values. This means that investing in undervalued stocks is indeed an excellent way to increase your wealth. You also need to keep in mind that entire books have been written on this topic. If you're interested in some books, let me know in the comments below and I will gladly help you find them. I have given some quick starting points in this video. However, you will still have to do your homework and analyze whether a stock is undervalued or not. And yes, you should diversify your portfolio. Never rely on one stock. Always look for 3 to 4 undervalued stocks to minimize the risks of loss. Moreover, when you are searching for undervalued companies, I would highly suggest that you focus on a couple of industries you are familiar with. Well, that's all for our today's video, and thanks for watching it. Make sure to smash that like button, it would mean to us a lot. And if you have not already subscribed to Glory Investing Show, subscribe to it and press that bell button so you will be notified each time we upload an interesting video on this channel. And while you're here, click to watch one of these 2 videos that are appearing on your screen. We will see you there. Take care and stay tuned.